What is financial risk? Here, we first learn about the general concept of risk versus reward. Typically, this implies that if we take on risks, we can get a higher return. On the other hand, we can also risk losing some or all of our investment. To illustrate, risk straight line going from 1 to 10 is introduced, with 10 being the highest of risk. At 1, we have the absolute lowest risk investment, which is a government bond. The reason why this is perceived risk-free is because the government can simply print more money. Contrarily, a corporation would never, in theory, have a problem meeting their debt obligations. At the very top of the risk scale is a Ponzi scheme. We also learn here for the first time that when we invest, we compare it to the 10-year federal note. It is just a bond, which is our benchmark for investments. We will return to this several times in other lessons, but the importance of the 10-year federal note should be remembered for now. Different causes of risk are also examined in this lesson. The first and most common method of financial risk is excessive debt. The main reason for debt is that it speeds up time. For example, the corporation does not have to wait until they have made enough money to buy a given asset. However, you, as an individual, typically can't afford to pay for your home in cash. Therefore, you save time by taking on a mortgage. A metaphor from a computer game is used to signal both the benefits and costs of speed. As such, there is no problem in having a mortgage or having a small amount of the presence of debt in a corporation. The key word is manageable. Just as a very large mortgage is very hard to handle, especially if you want flexibility in your personal finances, the same is true for a corporation with a high amount of debt. Warren Buffett has very strong opinions about debt. He knows that when times are bad, the corporation that has incurred too much debt will suffer, and therefore, he does not invest in leveraged companies. Another financial risk according to Warren Buffett is price. Even the best asset can be bought at a steep cost, and one way to analyze this is by valuating your home. Although it's a high-quality house, there will always be a limit to how much someone else would be willing to pay for it. The same is the case when you buy a stock. If you pay too high a price compared to the value of the stock, your return will likely diminish. This is also why Warren Buffett is famous for his quote, "Price is what you pay, value is what you get." There is no reason to pay 2,50,000 Indian rupees for a home worth 2 lakh Indian rupees. A value investor like Warren Buffett does the exact opposite when he buys stocks. He will buy the stock where the value is much higher than the price. Warren Buffett is also known for his quote on a third type of risk. Risk comes from not knowing what you're doing. While some people have definitely been burned by the housing market, the valuation of a home is something most people still understand. It is different when it comes to stocks that are real companies broken into millions and sometimes billions of pieces. Very often, stocks are not bought on a value-based approach where all facts are examined, but rather on emotions. An investor doing the latter is setting himself up for the third financial risk, not knowing what he's doing. Warren Buffett's determination of risk and investment strategy can be found in the Berkshire Hathaway letters to shareholders. Berkshire Hathaway is a holding company where Warren Buffett has created a 20% annual return. In his letters, he discloses and explains his successful investments alongside the investments where he completely misjudged risk and lost his money. 4 key points to remember. 1. Risk. A relative measure of the likelihood of losing your investment. The higher the risk, the more likely is it that you will lose some or all of your money in that investment. Warren Buffett's advice for identifying the 3 main types of risk. A. Excessive debt. B. Paying too high a price compared to the value you get. C. Not knowing what you're doing. 2. Debt. Debt generally occurs when you're borrowing money either because you don't have it, or you need some extra money to achieve a goal. Typically, debt is incurred when people speed up the process in order to afford whatever they want. 3. Value. Value is often very different from the price. It is subjective and must be estimated. A value investor like Warren Buffett pays a lower price than the value of a stock or bond. 4. 10-year Federal Note. The only difference between a note and a bond is the duration of the loan. Bonds with durations of 10 years or shorter are called notes. Thanks for watching.